Hello everyone, and welcome back, or welcome, for the very first time to the Kingdom of Goshen, a prophetic sanctuary for the remnant. Today I want to share something most people never learn: how billionaires, wealthy families, and even royal families grow and protect their wealth while minimizing taxes. And no, this isn't illegal or shady. These are legal, smart, and strategic methods that have been used for generations to build generational wealth. By the end of this, you'll understand not just the what, but the how and why behind these strategies, and how even someone starting small can apply the principles to protect and grow their own wealth. Number 1. Start by buying appreciating assets. Think about it. Cash loses value over time because of inflation. If you keep your money in a bank account, it's slowly shrinking. The ultra-wealthy don't sit on cash. They buy things that increase in value. Real estate, stocks, private businesses, and even rare collectibles are common examples. For instance, the Walton family invested heavily in commercial real estate decades ago. Properties bought for a fraction of their current value are now worth millions. Similarly, the Rockefeller family held long-term positions in energy companies. Over decades, the growth was exponential. Even European royals collect rare art that can double or triple in value over time. The key here is to choose assets that not only appreciate, but can also generate income. That way, your wealth is working for you, not just sitting there. Number 2. Borrow against your assets. Here's something counterintuitive. Instead of selling your investments and paying capital gains taxes, wealthy people often borrow money using their assets as collateral. Loans aren't considered taxable income, so you can access cash without triggering taxes. For example, imagine a portfolio worth $10 million. You could take a loan for $1 million against that portfolio. You now have cash to invest, buy property, or fund a business, all while your original investments continue to grow. Families like the Rothschilds and Rockefellers have used this strategy for generations to fund new ventures without ever selling their core wealth. Number 3. Use trusts for protection and transfer. Trusts are legal tools that help wealthy families protect assets, minimize taxes, and control how wealth passes to the next generation. There are several types of trusts: dynasty trusts, which can last for multiple generations; grantor-retained annuity trusts, which transfer assets to heirs while minimizing gift taxes; offshore trusts, which provide additional asset protection and tax planning opportunities. For example, the Rockefeller family has used dynasty trusts to grow and protect wealth for over a century. A trust could be seeded with $50 million, and over time, that can grow to hundreds of millions, all while avoiding heavy estate taxes. Number 4. Maximize tax-advantaged education accounts. Education savings accounts like 529 plans aren't just for tuition. They can also serve as long-term growth and tax planning tools. Contributions grow tax-free, and unused funds can sometimes roll over into Roth IRAs, giving decades of tax-free growth. Imagine a family contributes $190,000 to a 529 plan. That money grows, and later it can be rolled into a Roth IRA, compounding tax-free for the next 30 to 40 years. This is how families supercharge wealth for the next generation. Number 5. Leverage real estate benefits. Real estate provides several tax advantages that most people overlook. Depreciation allows you to deduct property costs while the property appreciates. 1,031 exchanges let you sell one property and buy a similar one, deferring capital gains taxes. And heirs get a step up in basis, meaning they inherit the property at current market value, avoiding decades of capital gains. For example, The Walton family could buy a $500,000 property, which grows to $3 million. They could do a 1031 exchange, defer taxes, and the next generation inherits it with minimal or no taxes owed on the appreciation. Number 6. Use family limited partnerships, FLPs. Let wealthy families transfer ownership of assets to heirs at discounted values while keeping control. Parents can gift partnership interests at a discount, but still make decisions on investments, real estate, or businesses. For example, a family creates an FLP with $20 million in assets and gifts interests worth $2 million on paper. The children technically own part of the assets, but the parents retain full control over decision-making. Number 7. Implement estate freezes. An estate freeze locks in the current value of assets. Future growth passes to heirs, reducing estate taxes. For instance, a business owner might exchange common shares for non-appreciating preferred shares. Any growth in the company now benefits the next generation. Implement estate freezes. An estate freeze locks in the current value of assets. Future growth passes to heirs, reducing estate taxes. For instance, a business owner might exchange common shares for non-appreciating preferred shares. Any growth in the company now benefits the next generation, not the estate, lowering taxes owed when the owner passes away. Number 8. Use generation skipping trusts. GSTS skip a generation to avoid extra layers of estate taxes. For example, grandparents place $10 million into a GST. Instead of going to their children first, the assets go directly to grandchildren. This bypasses one layer of taxation entirely, allowing wealth to compound more efficiently over generations. Number 9. Invest in municipal bonds. Municipal bonds provide tax-free income. Interest is often exempt from federal and state taxes, which makes them highly attractive for high-net-worth individuals. For example, an investor purchases $5 million in municipal bonds yielding 3%. That 3% is federal tax-free, which often gives a better effective return than taxable investments. Number 10. Use offshore trusts and accounts. Wealthy families and royals sometimes place assets in offshore trusts to protect them legally and reduce taxes. For example, European royals might hold $100 million in a Swiss trust. Assets are growing internationally, fully legal, and with minimal tax exposure. Number 11. Maximize retirement accounts. Even though retirement accounts are available to everyone, the wealthy use them strategically. Roth IRAs grow tax-free, and 401ks reduce taxable income while contributing to investment growth. For example, investing $50,000 per year in a Roth IRA over decades allows that money to compound tax-free, creating an enormous advantage over taxable accounts. Number 12. Practice tax loss harvesting. Tax loss harvesting means selling investments at a loss to offset gains elsewhere. It reduces overall tax liability without affecting long-term strategy. For example, if a stock dropped 20%, selling it can offset gains from other assets, reducing taxes owed while allowing you to reinvest strategically. Number 13. Use charitable remainder trusts. CRTs provide income now, with the remainder going to charity. You get a charitable deduction up front and avoid capital gains taxes on donated assets. For example, donating appreciated stock to a CRT lets you continue receiving income from the trust while your assets grow tax efficiently. Number 14. Use life insurance strategically. Permanent life insurance builds cash value over time and can be used as collateral or for tax-free inheritance. For example, a $5 million whole life policy grows cash value tax-deferred. Upon death, the heirs receive the death benefit tax-free, giving another way to pass wealth efficiently. Number 15. Employ active asset management. Wealthy families don't rely on luck. They hire advisors to manage taxes, investments, and estate planning. They diversify globally and reinvest returns strategically. For example, royals and billionaires have entire teams monitoring laws, taxes, and investment opportunities worldwide. That's why their wealth continues to grow while minimizing tax exposure. These strategies are fully legal and widely used by the ultra-wealthy. Borrowing against assets, trusts, municipal bonds, insurance, and smart asset management are the core tools. Even if you're not a billionaire, understanding these principles lets you grow and protect your wealth efficiently.